This episode is going to look at the basic financial statements. Once we go through a period where the accounting system is recording business transactions, we can prepare reports that summarize all of those business transactions. These reports can be done monthly, they can be done quarterly, semi-annually, or annually. The financial statements are prepared to report a summary of the transactions that have been recorded. Those reports are prepared in the following order. The income statement is prepared first, followed by the statement of retained earnings. Third is the balance sheet, and finally the statement of cash flows. All companies prepare these 4 basic financial reports. Starting with the income statement. The income statement reports revenues that are earned and expenses that were incurred during a period from the operating activities that result in a net income if revenues exceed expenses, or a net loss if expenses exceeded revenues. And it looks something like this. The heading of a financial statement will always have the first line, the company name, the second line, which statement it is. Here, this is the income statement, and the third line is the date. The income statement will report a summary of revenues that were earned and expenses that were incurred over a period of time. So this particular income statement is reporting the revenues and expenses for the period month ended December 31st of 2019. Total revenues recorded during the month were $3,000. Total expenses recorded were $800. Revenues minus expenses gives us the amount of net income. Notice the single underline that represents a subtotal, indicating numbers directly above that line are combined to get the number below. This double line indicates a final total, reflecting the end of the statement. Net income is the difference between revenues and expenses, and it measures the company's profitability for the time period reported. Once the income statement is prepared, the company can then prepare a statement of retained earnings. The statement of retained earnings reflects the changes in the company's retained earnings from the beginning of the accounting period being reported to the end of the accounting period. So here we are seeing again the heading, company name, second line which report this is the statement of retained earnings, and third line the date. The retained earnings statement reports changes for the month ended December 31st of 2019. Retained earnings began the month with a 0 balance. We can assume that this was a brand new company, had nothing recorded when they began the month of December. During the period, the amount of profits increased retained earnings. We could go back and re-report revenues and expenses, or the measure of the profits, or since we've already calculated the amount of profits and summarized it in the prior report, the income statement, we just take the amount of net income from the first prepared report, the income statement, and carry it forward to the statement of retained earnings. So we started with 0 in retained earnings. We're increasing retained earnings $2,200 during the month. Then retained earnings is decreased by the amount of dividends that were paid. During the month ended December 31st of 2019, $500 in dividends were paid and recorded in the accounting system, resulting in an ending balance of retained earnings, $1,700. Again, single line, subtotal, double line, final total. Now that we've seen the first report, income statement, the second report, statement of retained earnings, let's examine the third report, the balance sheet. The balance sheet will describe a company's financial position on the last day of the accounting period. It is going to report the total amount of assets, total amount of liabilities, and total amount of equity. So again, heading, first line company name, Second line, which report this is the balance sheet. Third line, the date. Notice the date on the balance sheet is different from the date on the income statement and statement of retained earnings. The balance sheet date is reflecting the assets, liabilities, and equity on the last day of the accounting period reported. Think of it as a snapshot or a screenshot, one day in time, the financial position of the company. So looking in the accounting system, we would take the ending balances in all of our assets, ending balances and liabilities, ending common stock balance, plus the ending retained earnings. Recall that as we are recording transactions that affect retained earnings, which are revenues, expenses, and dividends, those are being recorded separately in individual accounts. We have summarized the impact of those transactions on retained earnings in the statement of retained earnings. So we can use that summary, ending retained earnings of $1,700 on the statement of retained earnings, and carry forward that summary amount to our balance sheet. This balance sheet is showing that total assets of $26,900 equal total liabilities and equity of $26,900, reflecting the basic accounting equation in balance. The fourth of the financial reports to be prepared is the statement of cash flows. And this statement shows the change in cash for a period of time for the month ended December 31st. It ultimately will show whether cash increased or decreased. It will ultimately show whether cash increased or decreased and reconcile the beginning amount of cash to the ending amount of cash for that period. It breaks down the cause of that increase into three types of activities that affect a company's cash. It's operating activities, its investing activities, and its financing activities. This statement will be explored in depth when we get to the end of the Basic Principles of Financial Accounting course.